Welcome to the Mortgage Foundations podcast, where we are here to guide you through the ins and outs of the mortgage world. Get ready to unravel the complexities and gain a solid understanding of everything you need to know about mortgages. Whether you're a first-time homebuyer or a seasoned homeowner, we've got you covered with expert insights and tips. Let's dive into the fascinating world of mortgages together. In today's episode, Tyler Cowell, the principal broker of Mortgage Foundations, FSRA number 13614, will discuss bridge loans and how they can assist with purchasing a home when selling another one.
A bridge loan is a short-term financing option designed to provide funding to bridge the gap between the purchase of a new property and the sale of your existing one. The need for a bridge loan arises when you are selling your current property and the funds that are meant to be the down payment for the new property are coming from the equity in your current property, and the closing dates do not align between the two transactions, specifically when the closing date for the new property is before the closing date for the current property. A bridge loan is not the most common transaction, however, they do arise, and it is important to know what they are and how they can benefit you when needed. It is also important to note that not all lenders offer bridge loans, and ensuring that the lender who will be financing the new property does offer them is crucial to making sure you can close on the purchase. Otherwise, alternative arrangements will need to be made. Discussing the need for a possible bridge loan well ahead of time with your mortgage broker will help to make sure proper funding is arranged. There are some extra fees and increased interest rates with bridge loans. However, they are quite manageable in most situations and can be easily calculated by your mortgage broker. Depending on the length of time that the bridge loan is required and the amount needed, a lien may need to be registered on title for the lender to provide the financing, and this may lead to increased legal fees. In most cases, a lender will require that you have a firm purchase and sale agreement in place on your current property before providing a bridge loan. However, there are some lenders that provide bridge loans in the absence of a firm sale. These bridge loans come with extra fees, but they are a great solution when needed. To give you an example of how a traditional bridge loan works, let's say you sell your property for $700,000 and you have $150,000 equity in it, which will be used as the down payment on the new property. The closing date for the current property is July 15th. And the closing date for the new property is July 1st. In this instance, since you would essentially own both properties for 15 days and your down payment wouldn't be available till the current property sells, the bridge loan lender provides the down payment until it gets repaid upon the sale of the current property. Bridge loans can be a convenient option that may alleviate some stress in the home buying and selling process. However, it is important to discuss the details of a potential bridge loan with a mortgage broker ahead of time to make sure everything can be set up properly. In conclusion, a bridge loan is a temporary financing strategy that can be put in place when closing dates between the sale of an existing property and purchase of a new property don't match up.
In today's episode, we explored bridge loans and how they can be used to help with buying a new home while selling a current property. We hope you found today's episode informative, and don't forget to hit that subscribe button to stay updated for our next episode. Thank you for tuning in to Mortgage Foundations, and remember, every home starts with a foundation. Your mortgage should too.